welcome to Strictly Money, where all voices matter. I'm your host, Sejal Patel. With the worst of the COVID pandemic presumably behind us, there's hope that better days are ahead for our economy. But we may not be out of the woods just yet. The Bank of Canada is now warning that high household debt levels, driven mostly as a result of a frenzy in real estate investment, could destabilize the economy as interest rates start to rise. Philip Petursson is Chief Investment Strategist with IGM Financial, and he joins me now with his take on the economic landscape and the impact on consumers and investors. Peter, it's great to have you on the show.
Jill, thank you for having me.
So we have some alarm bells ringing. Do you share these concerns?
Well, it's interesting. These are concerns that have been building over the last number of years, some would argue perhaps over a decade, as Canadians have taken on more and more housing debt, pushing up the value of homes across this country, and really, I would say, continuing to inflate a bubble that has been a concern of the Bank of Canada and many in the industry for a number of years. So it's not new. It just continues to be brought to the forefront.
Do you have any sense of what sort of changes we have seen in the debt levels, pre-pandemic and then now? And I should probably add that they're saying, housing prices on average are up 30%. Just recently.
Yeah, it's a combination of things. Pre-pandemic, we were at a period where the Canadian household debt to income levels were exceptionally high, and they continued to climb. And there were fears that as the Bank of Canada was increasing interest rates back in 2019, that would have created greater strain and eventually would have burst this housing bubble. Then COVID comes along, the Bank of Canada cuts rates to zero, money is cheap, money is affordable, and guess what happens? The housing boom just gets reinflated. Now debt levels continue to climb. So the problem was temporarily put aside, I would say, but now it's been picked up in full force, and the Bank of Canada is saying we're between a rock and a hard place here. We have to raise rates eventually to fight inflation that we can see as being more persistent. And yet, as soon as we start raising rates, the number of mortgages out there that are on variable rates are going to feel the impact immediately. So how do they do this without collapsing, or maybe collapsing is the wrong phrase, but harming or creating headwinds for the Canadian economy?
Yeah, Phil, it's interesting because it looks like around 50% or so are in variable rates. And then there's ones who probably entered into mortgages recently, so they have a little bit of breathing room. And the other aspect that I thought was interesting about this is that the real concern is this surge driven by investors, so people who are not actually living in their homes. So, my thinking was, wouldn't they be a little bit more protected? And we have some leeway.
Yes and no. I think ultimately it comes down to interest rates and what people can afford. If people have pushed themselves, whether they're an investor or a homeowner that is living in the house, if they have extended themselves a little too far with no margin of error for interest rate increases, then where is that additional money that's going to basically fund that mortgage coming from? It's coming out of consumption, it's coming out of savings, coming from somewhere else. And that's really the concern, is that, is there really any protection on any side of it? No, investors have extended themselves just as much as homeowners have. The problem is widespread.
Yeah, the housing affordability problem, it has a knock-on effect. Like you just said, if they're making sure all their money is going towards keeping that roof over their head, they're not necessarily eating out and they're not saving for retirement. What sort of impact do you see this having on, say, GDP and consumption, and even consumer confidence?
It's going to have a big impact. And when we look at Canadian GDP, guess what? The largest component to our economy has been the housing market, whether it's construction, whether it's associated with real estate. It's a significant part of our economy. And so if that was to slow down, because housing starts would slow because people couldn't afford homes as much as they can today, or that's debatable whether they can or not, but it would have a material impact on Canadian GDP, on the Canadian economy, just from the housing activity, let alone the drop in consumption that's coming from having to take the cash that would have been spent elsewhere to fund that mortgage.
In hindsight, and we only have about 20 seconds before the break, Philip, do you think all this printing of money, this easy money, was a mistake?
I think the extension, it went on a little bit too long. I think you needed to print money to keep the economy moving forward during the COVID lockdowns, but it should have been removed as soon as things started opening up, a lot faster than it has been.
All right, we're going to take a quick break and we'll continue this conversation. We're here with Philip Petursson of IGM Financial. Philip, with inflation the way it is in decade highs, what do you think, how transitory do you think this is? Because, we can see supply disruption working its way through. On the other hand, when you have wage hikes, that tends to be more permanent.
It's a great question, Sejal. When we think about transitory, I think this has to be the word of the year. It's been tossed around so much and perhaps misunderstood more than any other word. I think you really have to define what transitory means. I think some mean that transitory is inflation that is going to start to moderate a lot quicker than what I think is actually going to do. So people are saying that inflation is going to moderate in the first half of 2022 after expecting it to moderate in the back half of 2021, which it hasn't. It's remained quite lofty. We have to think of it this way. You mentioned it in the last segment. All of the money that had been created to support the global economy during the COVID lockdowns, which amounted to $16 trillion, that resulted in a permanent increase in demand, in my view. So that was inflationary, and we're feeling the impacts of that now. Yes, the supply chain disruptions are a part of that, but that doesn't alleviate or it doesn't change the increase in demand that we have today and likely are going to continue to have through 2022 and into 2023. So inflation is going to be far more persistent, maybe not at the 6% level in the United States or the 4.5% level in Canada, but it's going to be far more persistent at higher levels than what we've seen over the last 10 years.
So as an investor, what do they do? Because it feels like we're in this period of uncertainty and volatility. How does one position their portfolio?
Well, it's a great question, and you have to consider inflation with your portfolio because it erodes purchasing power. So ultimately, what we're trying to do here is protect our purchasing power. How do we do that? Well, bonds are likely to face headwinds with higher inflation and with a coming rising rate environment. So we probably want to be underweight bonds, overweight equities, where we're looking at companies that have pricing power. So in an inflationary environment, those companies that can pass on the costs to their customers will do better. Now, it seems that the customers right now are accepting higher costs without really too much of a fight at all. So this is what we're seeing reflected in earnings and reflected in the overall stock market. Equities are a good inflation hedge. Again, especially those companies that can show or demonstrate that they have pricing power. Other good hedges in terms of inflation would be as real estate or real estate investment trusts. And then gold historically has been one. It hasn't really worked well through this go around. And I think it's fighting the US dollar right now. As the US dollar is showing strength, gold is showing a little bit of weakness, but I think that can reverse course into 2022. And we can see gold start to prove itself as that historical inflation hedge again.
Philip, what about cryptocurrencies? Because a lot of talk that it's sort of replacing gold as an inflation hedge. What are your thoughts?
It's another great debate out there in terms of what is the true value of Bitcoin, what's the true value of Ethereum, and the answer is we don't know. We don't know what the true value is because it doesn't correlate well to equities. It doesn't correlate well to other currencies out there. So it probably hasn't found its true measure of value yet. Some are saying, look, this is a good alternative to other asset classes that are out there. I would say that you really want to measure the weight in crypto relative to what you can handle from a volatility perspective. Look, these cryptocurrencies are highly volatile. They can be up and down by a significant amount. And therefore, if investors wanted to, it's not necessarily my recommendation, but if investors wanted to own it in proportion to the risk that it exhibits, meaning it should be perhaps a smaller weight in anyone's portfolio should they choose to own it at all.
Do you see more upside in Canada in terms of the markets or the US?
Well, great question. As we head into 2022, as we're formulating our 2022 outlook, we do see a valuation advantage in Canada in 2022 over the United States. Both equity markets we think will be positive in 2022, but we think Canada can edge out the US. The US is more expensive. It's hard to find bargains in the United States right now, whereas Canada is showing better valuation. And in addition, we think that oil prices, which has been a positive contributor to TSX performance historically and continues to be so, we think oil prices can continue to push higher in 2022. That bodes well for the TSX as well. A higher interest rate environment is good for our financials. Those two sectors are almost 50% of the market as a whole.
All right, so valuation and better upside in Canada. Thanks for coming on today, Phil. Appreciate your time. Philip Petursson, Chief Investment Strategist at IGM. Stay with us because after the break, we're going to discuss debt levels in Canada and the rising use of credit cards. Welcome back to Strictly Money. As life post-pandemic returns to a new normal, pent-up demand is just one of many reasons sending credit card spending to its highest level in 3 years. To discuss this and the impact on credit scores, Rebecca Oakes joins us. She's AVP of Data and Analytics at Equifax Canada. Hi, Rebecca. Great to have you back on.
Thank you for having me.
So you mentioned in a report that credit cards have been the slowest product to recover from the pandemic. Can you explain the change and what's driving the increase?
Absolutely. So last year during 2020, we did see credit card spending really pull back, and that was driven by lockdowns and people not being able to go out and kind of make the normal purchases they would do. That has definitely changed over the last few months. So as you mentioned, we're seeing credit card spend the highest for 3 years. And in particular, it's kind of more than 4% higher than it was pre-pandemic. And that's really been driven by people wanting to go back out, wanting to kind of do some of those activities that we kind of did before the pandemic happened.
So we saw the average monthly spend is around $1,400. What about actual usage levels? Because I saw that that's up. And I guess my thinking was, well, it seems like this cash is out of favor. It was definitely discouraged during the pandemic. Is that one reason, or is there more to it?
I think it's really just driven by more demand. So in particular, we've seen it on younger consumers. They are really spending more. So the under 35s, there's a much higher increase on those age groups. But the good news so far is that we are seeing payments still being made to quite a high level. So for every dollar of spend, there's around 97 cents of payments. So although balances are starting to creep back up again, it's certainly not in a situation yet where spend is kind of much higher than the payments that are kind of coming through.
Oh, that's a good sign. Do you, Rebecca, do you have a sense of how much inflation is playing a role with this uptick and Canadians just trying to finance everyday necessities?
Yeah, that's a great question. I mean, inflation is definitely linked to credit behavior. So what we have seen historically is that when inflation does go up and those day-to-day goods do start to increase, there is more pressure put on consumers in terms of how they keep on making those normal spending. And often, consumers will kind of reach for their credit cards if they can't fill that gap in the short term. Now, that's not too bad if it's a temporary inflation. If we are seeing that over an extended period, that can lead to more and more consumers needing to fill that gap with their credit card and balances start to increase. So it's definitely one to watch.
Yeah, definitely. I thought what was interesting, and I guess from a financial wellness advocate as myself, I was pleased to see that people aren't planning a huge holiday splurge. And in fact, it looks like a majority are planning or preparing a budget.
Yeah, so we did see in a survey we carried out recently, we were asking consumers exactly that question. We were saying, what are your plans for the holiday period? Now, it is up compared to last year, but again, last year was quite low. So I think if we look at consumers that said they were planning to spend more, it's around 9% compared to 4% this time last year. So it is on the way up, but it's certainly not huge numbers of people going out expecting to spend, much more than they did last year. So that is some good news.
Yeah. You mentioned millennials. Are there certain groups or characteristics that you see that are spending more than others?
I mean, it definitely is that's under 35 age group. They are spending much more than the over. And actually, when you look at the payment behavior, they actually pay a little bit less as well. So that is one group that we are closely monitoring, because obviously we want to kind of see, are they going to keep on being able to make those payments? But it is that age group. And again, that's really driven by perhaps, when I was younger, I wanted to go out and do a lot more. So, the pandemic's had a huge impact on a lot of people for varying reasons. So, it's understandable they want to be going back out and getting life back to normal as much as possible.
Rebecca, based on some of the trends that you have seen in this research, what are you and your team looking for in 2002, and how do you see spending play out and the use of credit cards?
So, I guess back to your question on inflation, if that does continue, we do expect to see that spend start to pick back up again. And we likely will see payments start to drop off. There were a lot of government support mechanisms that were in place last year, helping people through some of those financial difficulties with employment due to the pandemic. And they have started to be pulled back a little bit. So over the coming months, that's definitely one we are going to be watching, because people may start to find that they can't make some of those payments. So, that is kind of unfortunately the trend we do expect to see next year, is some rise in delinquency. Our advice to people, over the holiday period is always be very mindful in terms of how much you're spending. Look at your individual circumstances to make sure you don't end up in January with a credit card bill that, potentially you can't afford to pay.
Yeah, certainly inflation is on people's minds, as well as housing affordability and the knock-on effect that's having. We're going to take a quick break, and we'll continue this conversation. Welcome back. My guest is Rebecca Oakes of Equifax Canada. Rebecca, before the break, we were talking about credit cards. I want to switch gears a little bit and talk about credit scores and credit reports, because another report that Equifax conducted, 64% of Canadians said they had checked their credit reports in the past year. What's behind that?
So there's definitely more consumers, particularly on the younger side of things, who are really interested to understand how their credit report works, how credit scores are calculated, and kind of making sure that what's on their file is correct. So, we absolutely encourage this. And that's really why we're starting to see more people accessing their credit file. They just want to make sure everything looks up to date and get a better understanding in terms of, what that file looks like.
I thought it was very interesting, because you showed that there was this major shift. Like 78% of correspondents indicated that they had now checked their credit reports at least once. And then if you look back 5 years ago, 67% that they had rarely or never checked their credit reports. Do you think that is because there's just this awareness of the importance of credit reports, or is it more worries about their financial health?
I think it definitely could be both of those. I mean, if you think back to 2020, there were also a lot of lender programs in place to support through the pandemic. So things like payment deferral programs. And there definitely were consumers who were concerned around, what happens if I take those deferrals? What is that doing to my credit score, my credit file? So I think some of it is around awareness. Some of it is definitely around making sure that their credit file is correct, that there's no fraud, things like that on the credit file. But there's also a little bit of increased wariness last year because of some of those programs that were in place, and people just not understanding fully, what could be the impact if I take a payment deferral, for example. So I think that probably contributed to some of the numbers we're seeing this year.
Okay. So Equifax did put Canadians to the test to see if they actually understood credit reports and the scores. And you can see that there's still a lot of misunderstanding. So let's go through some of these. One was that if you have a good credit score, you'll always be approved for a loan. Now, this is false, but 48% thought this was true.
Yeah, absolutely. So credit scores do play a part of what lenders look at when you apply for credit, but they are only one piece of information and kind of one useful thing that they look at. They also look at other things like potentially your income, if you've given them that information, your employment status. It's just one part of many. So just having a good credit score in isolation, although that's a fantastic positive thing, it doesn't necessarily mean that a lender is still going to offer you credit. And at the same time, the reverse is true. Sometimes if you you have a lower credit score, again, it doesn't mean a lender is going to decline you for a credit application. It's just one of many things that they look at.
Here's another one. You have one credit score. Again, not true.
Correct. And this is probably one of the ones I see the most on credit scores. And credit scores, if you think about them in terms of something simple, like going to the supermarket. If you go into the supermarket and you go to buy tomato soup, there's lots of different brands out there. They all kind of have a similar taste, purpose, because it's tomato soup, but the ingredients are slightly different. And that's kind of how credit scores work. There are different algorithms, different ways in which scores are calculated. And sometimes they use slightly different piece of information. So although they're similar in terms of what they're predicting, there are different ones that are available. And some lenders choose to use one over the other. Therefore, it might vary in terms of what actually they use.
Now, this is one that I see a lot. Checking your own credit reports hurts your credit scores. 20% thought this was true. I hear this a lot.
Yeah, and it's definitely not true. So the only things that impact your credit score is if someone is checking your credit file for credit applications.
The hard hits.
The hard hits, exactly. You yourself going on and looking at your credit file, that's what us in the industry would call a soft hit. It's logged because we, as a reporting bureau, we have to log all access, but it does not impact your credit scores.
We have about 15 seconds left. Rebecca, how does one look at improving their scores? What's one thing that they can do?
So credit scores are all about the likelihood you're going to make payments. So good payment behavior, that's the best thing you can do to increase your score.
All right. Rebecca, thanks for joining us today.
Thank you so much.
As Rebecca Oakes of Equifax Canada. Well, that wraps up this edition of Strictly Money. As the holiday season approaches, please keep in mind your debt load. And if you haven't done a credit check, it might be a good time to pull up that report and see where you're at. You can catch previous episodes of the show on thenewsforum.ca, or if you have suggestions or feedback, please drop us an email. Until next time, stay well, stay wise, and stay wealthy.